Test 1, 2, 3. Well, good morning, everybody. This is the November 13, 2024.
Recording in progress.
This is the November 13, 2024 meeting of the LACERA Board of Investments Equity Public-Private Committee. We are going to call this meeting to order.
Okay, thank you, Chair Gatto,
I'm here.
Vice Chair Gatto. This meeting is being conducted as a virtual in-person meeting, so we'll do a roll call of the trustees to confirm attendance. Mr. Fay, Mr. Gatto,
I'm here.
Mr. Rue, Miss Mead,
Here.
thank you, and Chair Jones.
Here.
Okay, Miss Ginsburg, Miss Martin, Miss Langton, Mr. Green. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, Dale Johnson, and we have Elaine Moore from BlackRock. Trustees, please use your raise your hand option to be placed in this queue. At this time, we ask all meeting participants to mute your mic until you're ready to speak, and now we may proceed with the agenda.
Thank you very much, everybody. We're going to go right to item 3, which is approval of the minutes from the February 14th, 2024 meeting. Are there any comments on this item? All right, then without objection, the minutes are approved.
Actually, let's do a roll call real quickly.
Madam
Motion.
Secretary.
I need a motion.
Without it, that suffices under Robert's rules. But
you want to make a motion?
Oh, yeah, motion to approve the minutes.
A second?
all right, now without objection. the
Nate,
minutes
are you gonna second? Will you?
I can second. Oh, do we have quorum?
Yeah, we do. Okay. Mr. Rue's absent. Mr. Gatto,
Aye.
Miss Me,
Aye.
Mr. Jones.
Aye.
Okay, the motion passes unanimously.
And just FYI, for the record, under Robert's rules, which I believe we follow, you can proceed without objection if there are no objections. That's what I've been told. That's what I've always done.
You're right.
Okay. All right. Fantastic. All right. Next item is public comment. Item 4. Do we have any public comment?
No public
No
comment.
public comment. All right. Then we're going to go right to item 5, which is a report on global equity education. And we have some folks here from BlackRock. Welcome.
So good morning, Vice Chair, committee members, and trustees. This educational presentation is being provided to set the background for the growth structure review, which will be later this morning at the Board of Investments meeting. LACERA's global equity portfolio is externally managed by investment managers that employ various strategies to capture broad market returns, and in some cases outperform the market with moderate levels of additional risk. So BlackRock is here to present on the equity market structure and various approaches or strategies to managing equity portfolios. As noted in the cover memo, BlackRock manages $734 million in a European alpha tilt strategy, which is focused on European large and mid-cap stocks for LACERA. They have been managing this mandate for LACERA since 2007. Sitting to my left is Elaine Moore, Senior Product Strategist for the Active Equities Group at BlackRock, and I will now hand it to her for the presentation.
Great, thank you, Dale. Can everybody hear me? Wonderful. First of all, thanks for having me. Great to be here. And please, if there are questions or comments along the way, I'd love to hear any, during the presentation. So what we've set up today is to just do a bit of a primer on equity investing and some different styles of investing and how to think about making those sorts of decisions. So if I go to the first slide, slide number 2. There we go. Just to orient ourselves in terms of equity investing, and apologies if this is, if this we'll just start here and get more sophisticated as we go through. But just to level set here, equity investing is, of course, when we buy shares of stock. And the idea is that those shares increase in value. There's a couple of ways that those assets can increase in value. One is the capital gain, so that's just the price of the stock that you buy increases, and the other is dividends. So as companies, go through their normal course of business and generate revenues, they can also return some of those revenues to their shareholders via dividends. The other thing to think about is when we're thinking about investing is investing through funds. So you can buy stocks, as we said, you can also buy funds. Funds can help in terms of lowering some administrative costs, also provide access to more diversified investment strategies. It's a little just easier as you commingle and gather larger funds, and then those funds can invest in the stocks. And then the final sort of point there is that when you invest in stocks, there's also opportunities to increase those investments through things that are called corporate actions. So that's where companies might offer their shareholders the right to buy more shares, but maybe at a reduced price, a price less than the current market price. That's another way that you can think about that value increasing. But broadly speaking, I think we all know we invest in equities so that with the intention of generating returns and having those assets and those that market value grow. If you can go to the next slide, please. So the next comment I was going to dig into is all about index funds. So I think most of us have heard about that, but just to kind of dig into the detail. For an index fund, so indices you may have heard a lot about. The S&P 500 is the 500 largest stocks in the US. So names like Microsoft, Apple, NVIDIA are sort of the top names, the highest weight there. But the S&P 500 is simply the 500 largest stocks by market cap. And so if you are an index investor, what you're doing is investing in a proportional share of all of those 500 stocks. Some benefits of an index fund. One is diversification. So you get through investing in an S&P 500 index fund, for example, you are getting exposure to, your money is then being invested in those 500 stocks in market cap weights. So according to what the weights of the S&P 500 are, for example, that reduces your idiosyncratic risk. So that means, you know, you're less susceptible to some event happening, or some maybe a company goes bankrupt, or maybe there's a scandal, something like that. If you are invested in an index fund, you have broad market exposure. You have exposure to lots of different companies, and that's a good thing in terms of diversification. Another piece is cost. Of course, it costs a lot less if you are just looking to sort of match or track the index. In terms of from an implementation perspective, what we do on the index investment side is then take in the assets and then invest according to those to that S&P 500 breakdown. Or it can be an international index. It could be a fixed income index. There's many different indices and ways that we think about understanding markets and the returns. But an index investment can be a nice way to get pretty low cost exposure, because all you're looking to do is to deliver the return of the market. The final point there is on risk management. So because it's sort of a predefined target that you're looking to get exposure to, and also you're not expecting a lot of turnover. The S&P 500 and various indices tend to be what's called rebalanced or reconstituted once a year, something like that. So you can think about it being similar to like a buy and hold strategy. You're buying, and you're going to have to do some adjustments over time, but in large part, you're going to see pretty low turnover, and that's good because turnover is going to generate costs. So those are some of the kind of benefits. If we think about how we apply these and kind of what you are getting out of this kind of exposure, it can be a good gauge of market sentiment. So again, markets go up, markets also have difficulties, have declines. Maybe there's a big shock that happens in the world. Maybe there's something surprising that happens, geopolitical events, et cetera. And markets will react to that. And so investing in an index fund will give you exposure. You will see and experience a similar volatility in an index fund holding as you would, of course, in the index. Performance measurement can be pretty straightforward. You are just looking to deliver returns that are going to be in alignment with that benchmark. So understanding risk and return is a little more straightforward. You're looking to manage the risk relative to the benchmark which in an index fund is going to be basically zero. You're going to be as closely tied and as closely aligned to that index as you can. Index investing also can be a nice way to affect different asset allocation decisions. So as I mentioned, there's lots of different kinds of indices. You can invest in equity indices, in international indices, in fixed income indices, et cetera, high yield indices, lots of different ones. And I think all of these things kind of boil down to, in my mind, I think about transparency. It's very clear with an index investment what exposure you're getting in your portfolio, and it's very clear to sort of measure and monitor and see how that changes from month to month, quarter to quarter, et cetera. I will keep going, but please, any questions, I would be happy to take along the way.
Well, that's the case. I have one real quick.
Please.
So with something like the S&P and the amount of concentration amongst all types of investors into that, it's a broad-based index, but also it's easier to, more people are investing in those companies. And how do you see, and on a go-forward basis, as more people crowd into it, is that something that we should be looking out for as like its own separate risk? Or is that something where it's just like it's part of the market and that's just what it is?
Yes, I think that's a very good point. Concentration, especially in the US market, is particularly high. Yes. So I would think about that in a sort of portfolio context, and think about trying to, I mean, your choices are, and we'll get into this in more detail, but if you want investing in equity markets, you can invest with an index fund, or you can try to be more active, and that would be trying to take positions that are different than the benchmark. And you could do that, and you could underweight. You could say, okay, I'm going to stay away from these, the very growthy end of the S&P 500. I think that's just a bit of an investment decision. I think that through time, I would, these things tend to sometimes can get a little bit overdone and then come back. So I think the hard thing about that element, so things, sort of running up, to sort of excessive levels, is those are very hard to time. And an index fund strategy is taking the view that I don't want to have to try to time that. I'm just going to sort of take the market exposure, and maybe there's other ways in your portfolio you can think about mitigating.
So the chairman is here, by the way. So I'm going to turn over the gavel, but I wanted to build on that question real quick, because I'm not sure if my question is the same or if it's a little different. I thought it was what he was asking, which is there are some who identify systemic risk with the rise of index funds, whereas greater percentages of the market are controlled by index funds. The purchasing of equities becomes automatic, and there's really no opportunities or lesser opportunities for price discovery. And in the long run, do you see a risk for pension funds? Because we're always going to have some index funds, right? But as more of the market goes on autopilot, there's less price discovery. Are we all just rushing into something that will collapse even greater when it collapses?
Got it. Understood.
Is that your question?
Yes, thank you. My take on that is, I mean, I've been in investment management my whole career, so I don't see that as an industry really shrinking. What I see it doing is changing. So yes, if all pension funds are invested only in index funds, I think there can be an extreme, and that can create some risks. But what comes to my mind is there's lots of different kinds of ways that price discovery can happen and different market participants. And I think that is what has changed over the years. So it has been, it used to be a little bit more, proprietary trading at investment banks and broker dealers and sort of the sort of top tier broker dealers you can think about. Whereas today it's a little bit more typically in the hedge fund or what's referred to as pod shops these days that do a lot of that intermediation. So, yes, it's the case that there's lots of price discovery, I think, that happens there at the sort of shorter end of a time horizon relative to sort of a pension fund investment. So I think that still happens. Maybe the difference is just who's driving that and sort of who's able to kind of capitalize on that. So I think if you're thinking about an overall investment kind of asset allocation, you want to have exposure to both, right? And so some of those shorter term, I would call it kind of hedge fundy or pod shop areas would be a way to kind of balance that and mitigate that. Sure. All right, I will move ahead. That's all right. So on slide 4, and this kind of underlines some of the things we were talking about, but if you think about evolution in markets and just thinking about the different ways to frame your investment strategy, this is sort of doing a little bit of a in the way past, in the medium past, and then sort of today, how we think about what the exposures are, and then that can inform how we want to think about investing and getting exposure to and delivering returns based on those elements. So in the past, you can think about why do you investing in markets, investing in equities was about just generating absolute return. You want your money, you want the price of whatever you're purchasing to go up. In the 90s or so, we sort of moved to an idea and an understanding of a market exposure. So that's beta. So you can get your index return from your investments, whether it be S&P 500, MSCI, or other international indices. You can decide what areas of the market you want to invest in, but getting the beta, just that market exposure, is pretty straightforward. And the other element, of course, is what we call alpha, and that is generating return above the benchmark, whatever that benchmark is. It could be cash for a hedge fund. It could be S&P 500 for a US large cap strategy. But just thinking about a more precise way to think about and measure measure returns is sort of the what's happening in the 90s. And then today we also think about these things we call factors. So we have market beta. We know that's just exposure to the market. Alpha is return above the benchmark. We also have things called factors, which are what are common attributes of stocks. So you can think about the very sort of growthy end of the US market, Apple, Microsoft, NVIDIA. What do those companies represent? There's something common about them, and that's growth, right? They're promising and have delivered a lot of growth on their investments. So that is what we would call a factor. So you can also think about breaking down your investment exposure to beta and also a complement of exposure to factors of things like growth, value, momentum. Those are sort of attributes of those investments, those stocks that you're going to hold in your portfolio. And then what's left over, that alpha, is what we would call idiosyncratic or kind of pure alpha. And the reason is it's not going to be driven by those common factors. Common factors, if you look back over 100 years, have on balance added value, meaning if you invest in growth, that has tended to add value. If you invest with a value orientation, and that is investing in stocks that are priced cheaply relative to something, tends to be a winning strategy over the long run. The challenge is those things can have very long cycles and they can be very hard to time. So you might want exposure to those factors, but you want to be very sort of considered and careful in that, it can be hard to stick with a factor that doesn't perform and doesn't deliver on that return over long periods of time.
Elaine,
Mhm.
so then you take the factors out, then what is the alpha, the idiosyncratic alpha now being generated from? If it's not from a value strategy, the growth strategy factor, what have you, what is it exactly that the investor is generating the return from? I'm just trying to understand what's the relationship.
It's the company specific aspect. So if you take Microsoft and Apple, right, they're both growthy. They're both in sort of the IT sector, but there's going to be differences in how Microsoft delivers on its objectives and is able to deliver on its sales targets and revenues and et cetera, relative to Apple. So what the alpha piece, what we're talking about here, is the idiosyncratic piece that's very stock specific. That's going to be something specific to each of those companies, not something that is common. The factors are things that are common.
Yeah. So then is it basically a proxy for management?
Oh, interesting. I think that would be an element of it. If I think about the team I'm a part of, thinks is a systematic team, which means we care a lot about data. And so we try to measure and understand lots of different things about as much as we can about different companies. But I don't, yeah. I think you can think about it as attributing to management. I guess I would say that's probably not the only thing. If I'm just sort of thinking about what's different about, most companies are going to have slightly different, ways that they're set up, slightly different models, business models, slightly different product sets, slightly different, target markets, all of those sort of things. So I think those are also going to be some sources of why, Apple and Microsoft are going to have different returns. So I think a piece is going to be management, but I think some of the other things are just going to be, there's always going to be some nuances and differences business to business.
Interesting. Okay.
Question. Do you think about the end user, the end customer from these different companies? So to your point with Microsoft and Apple, or Amazon's not technically in IT, but even though there's AWS that should be part of it, do you think of what those things have exposure to if you're talking about inflation being high, people not being able to buy iPhones, but they'll still use AWS, they'll still use ChatGPT or OpenAI, since Microsoft owned a bunch of it. Do you think of the end user and the products that are being sold, like what the inelasticity of demand is for those products?
In terms of evaluating investments? Absolutely.
Okay.
Absolutely. Yes. Yeah, you're skipping to the bottom line here, but yeah, no, thank you. That's absolutely what, especially, well, as an active investor, you're trying to exactly understand those kinds of things. So what are the, how are the new products being received by different clients? What are the other indications? What other, especially in this virtual world we all live in, there's lots of what we call digital exhaust, right? So there's lots of information you can pick up and it can help you understand something about those companies, which exactly gets to that point. Okay, I think I'll go to the next slide, if that's all right. So slide 5. This is just we've kind of set this up already, but just to review a little bit in terms of a framework in terms of understanding and thinking about equity investing. So we've laid it out across the spectrum here. On the left-hand side, index, and so just review that attributes there are pretty low cost, very transparent, active risk. So we talk about things in terms of active and total. Active risk would be any deviation you're taking relative to the benchmark. If you've selected the S&P 500 and you're going to get that exposure, we call that zero active risk. So you're not taking risk, you're just looking to deliver on that market exposure. In the middle category here is a systematic. So the I have to give you the caveat that that's the team I'm a part of is focused on systematic investing. So what that means is we try to use a more disciplined and quantitative approach to portfolio construction. That means we tend to have very broad portfolios. You're looking to capture lots of different kinds of data to help understand and think about positioning your portfolio. What that means is we tend to have pretty broad portfolios, so we have hundreds of positions, and we look to build models to understand and think about where the opportunities are. From a risk and sort of exposure perspective, we've kind of gone through on the factor side. Those tend to be, I would call it sort of lower on the active risk, but you can take some risk or some positioning relative to the benchmark based on those factors. Again, the sort of well-known investment ideas and typically a more rules-based approach. The systematic alpha is focusing on that alpha component that we were talking about in the previous slide. So again, looking to minimize the exposure to some of those well understood attributes and really maximize and get as much exposure as we can to that idiosyncratic alpha. The idiosyncratic alpha is super important because that's very valuable, because that can deliver in lots of, it's not regime dependent. So in the factor space, if you are exposed to value, you need that to be in favor, and you need that to be delivering in terms of the market return. And sometimes it will be, and sometimes it won't be. Say growth would be a good example there. In the recent past, growth has been on a tear. You kind of can't lose with just having exposure to growth. But idiosyncratic alpha, or what we call pure alpha, is regime independent. So we don't need there to be a big value run or growth. You're able to deliver because it's very stock specific. It's less regime dependent. And the final area there is fundamental. I think this is something that it's the more traditional, very qualitative, very tending to be very deep in terms of analysis, can tend to be a little bit higher in risk, usually very concentrated portfolios. So, it can be a manager who has 20 positions or 30 positions or something like that. Very, very, what we would call very, very deep from a fundamental and very qualitative. So this tends to be built around, there's the sort of star
Kathy Wood.
person. Excuse me. Yes, exactly. Although some might argue that that's a little bit of factor exposure because it's very growthy, right? But yes, agreed. So another way to think about just sort of the difference between a more systematic versus fundamental, I like the analogy, at least years ago, used to say that systematic investors tend to be a mile wide. You have an attribute or an insight that you apply to many different stocks, but an inch deep, in that you don't really know a lot about every specific company. Whereas on the fundamental side, inch wide, but a mile deep. So like know everything about those particular companies that are in your portfolio. I would say, I think, especially in the world of lots of different kinds of data available out there, and with a systematic approach, we've gotten much deeper than an inch, but those are still some ways to think about those are different approaches, right? You can believe in a very deep, very focused portfolio, or one that's a little bit more broad.
Then the next question would come down to, on the fundamental side, which used to be the more, you can restate it for me, used to be the more, if you want to go back to the 1990s, much more of the value proposition. Now it's become less of the proposition. When we look at who's actually accomplishing returns above the pitch, that they make to pension funds or whatever else, if you look at fundamental alpha managers in general delivering on the pitch, or is it the reason all the money's moving more into index and systematic is because the performance is more consistent and more predictable than the fundamental alpha can deliver, given the amount of active risk that's there?
I think it's hard. I mean, active management is definitely hard, right? I mean, start from there. Active management is hard. It's hard to be the benchmark. You have to that requires doing trading, and trading costs money, and you're playing a very difficult game.
Right.
If
And
you-
it's which is why we'd be paying the fees, right?
Exactly.
So, I mean, so you're paying for a high press quarterback. Question is, are we winning? Are we making the playoffs? Like what's going on with the fundamental
I mean,
guys?
I think it depends on, it depends, right? And so there are certain, I think managers, so if I think about BlackRock and I think about the team I'm a part of, I think we have done that. We have delivered returns above the benchmark in a lot of, if not most cases. I think the hard thing is measurement of those, because there's going to be periods where things don't work. There's going to be periods where you have underperformance.
Mhm.
So is it going to always be outperforming over every time period, over every cycle? No, but I think you have to pick a reasonable time of a period of review and then make a decision. And I think fee alignment is super important. So you make sure that the fees that are being paid relative to the performance delivered is in line. I don't know if this resonates with you all, but something we do quite a bit is performance-based fees, so that the fees are generated essentially when performance is delivered. So that kind of helps get around that, because it's hard to, I think manager selection is hard. Everybody's gonna, have a great story, but in terms of delivery is, it's harder to do in practice and consistently and repeatedly.
Thank you.
Sure. Okay, I will keep moving. So this slide, just sort of review of how we're setting up the different styles. So within active management, so this is of course moving beyond index and thinking about the different approaches and just putting it in a little bit different stylized framework. In terms of the systematic approach, you can think about that factor exposure we were talking about, or and also the pure alpha is and the idiosyncratic return, which is I think the most valuable and going to be useful from a allocation perspective. Moving to the next slide. So we've sort of covered this, but we'll talk about it a little bit here. So in terms of the fundamental investing approach, as we mentioned, the mile deep. So this is looking at a lot of, this is, well, being a systematic investor, this to me feels a little old school. Like this is sort of like I go meet with all the company managements and I hear what they have to say, and I can tell that, this one is, really got a good idea and that one doesn't have a good idea. And I'd say a little bit more qualitatively oriented, although I think, to be fair, I think as investors, we all care about data. That's how we make decisions. So I think it's just a fundamental approach tends to be a little bit more, I'd say, deeper and a little bit more qualitative, a little bit more. I'd say the investment process you're subscribing to is really in that person's head, and in terms of how they think about making these evaluations and decisions. I think, some benefits there, if we want to draw out, like it's potentially a little bit more flexible and can react to changes that happen in markets or to those particular companies that these teams and investors are following. But yeah, I think all of these things from an active investment perspective, I think you want to pick a reasonable horizon and evaluate, did this investment deliver as expected, and what are the sort of contributing factors? What are the reasons? What are the things that went better than planned? What went worse? And can you sort of understand what those different attributes and dimensions are?
So one question or for the fundamental investing side, for anything that's systematic and there's a lot of data, it means that it had to have happened for it to be measured, right? And as you say, you're going to go talk with, if the fundamental person is going to go speak with the managers and they do see something that's different, that's something that may not have appeared in the past data, a new product, a new something. And so what do you think about that and of course there's a place in portfolio for everyone. Does that make sense if someone were to pitch a fundamental strategy to us saying that, hey, look, you're not going to have data on something that doesn't exist yet. We can't show you what the sales are of this thing yet because it's about to come out next month.
Yes, great point. I would say that yes, that has some truth to it in terms of if you're looking at financial statement data, right? So you're looking at 10K or Q or whatever's already happened. Yes, I would try to make the case that there's all this different data out there. We tend to refer to it as alternative data. So you could pick up on news stories. You could pick up on conference call transcripts where companies are talking about, new business line going very well, opportunities happening here, those sorts of things. So I think there's different types of data that you can use to incorporate that element. I mean, if we all had data on the future, then that would be wonderful. But I don't think there's that's not an option. It's more about what are the different data points, and then the approach fundamentally, I think being a little bit more focused on that persona, on whoever's making that judgment and that call, versus systematically we try to be a little bit more disciplined in terms of how we apply those kinds of insights.
So thank you for the question. I think it's interesting in this aspect that fundamental investing, I think what managers are trying to assess is what is the strategy of the company and what benchmarks are they using to measure that strategy and execution on it. So there's a little bit more of a forecasting approach, I think, in the fundamental sense. And that's probably not as apparent in the quantitative or systematic, where it's just measuring the data. So I think it is a different approach.
I should say, I was thinking about, let's say there's a company that's about to get a huge government contract. They're not going to talk about that in an earnings call, and they might let it slip, or they might be something that if you're a good fundamental manager, you might see, oh, wow, they did this thing. Those are the kind of things you can do when you're getting gearing up for a big contract that will, of course, affect revenues and everything else. So systematic makes more sense over the long term, but for someone who is really good, now can they be that great quarterback every season? That's less likely, but just wanted to put it out that way too.
Yep, definitely. Thank you. All right, so moving forward. So the next couple of slides are in systematic investing. So this is sort of in where I've spent my career in terms of focusing on. And this is just a couple different ways to think about active returns. So on the left-hand side, you can think about, of course, this is sort of the little bit of the past versus today. And I think it's helpful to think about breaking up your investment in terms of how have the returns been delivered. What portion of that is beta, is just based on the return to whatever the benchmark or index is. What portion is from exposure to different factors, and what portion is that what I would call pure alpha or idiosyncratic. But I think thinking about returns in that framework, in terms of where are the returns coming from, can help you think about how to maybe that spurs a sort of decision or a vision in terms of how you want to build the portfolio. On the right-hand side, of course, looking at how different strategies on the systematic side would look on those different dimensions in terms of returns coming from alpha, beta, and factors. So, of course, a systematic strategy, this is what we would call a long-only strategy. So take a US large cap, for example. We are going to own a couple hundred of stocks if we take the S&P 500, and you're going to deliver on that beta. So we're going to deliver a beta of 1. We're going to deliver whatever that S&P market return is, and then there will be some amount of factor exposure. So it's really hard you can't get it to 0. The only way to have 0 factor exposure is to be an index, depending on how you're defining and measuring, but you're going to have a little bit of exposure based on the positions you have in the portfolio. But the focus and the orientation is to build a portfolio to deliver on that what we would call stock specific or bottom-up stock selection. Those are the other kind of terms you'll hear about focusing on that alpha or that idiosyncratic portion. A factor-based strategy is going to have just that, deliver the beta exposure along with that factor exposure. Again, I think that challenging thing with factors is that again, if you look over 100 years, these things tend to add value, but over any time frame, even sort of less than a market cycle or a year or a few years, they can be challenged and have a difficult time in terms of delivering returns. The other option there on the right-hand side would be a more alternative strategy. So that's more in like sort of the hedge fund side. And that would be a strategy where maybe you have long and short positions, meaning you're sort of insulating your portfolio from, whether the market goes up or goes down, you can still make money because you're not having that market exposure. You're looking to deliver returns based on the stocks that you're long go up and the stocks that you're short go down. But that's another way to think about a systematic approach and sort of, from a systematic perspective, we're very precise in terms of how we think about quantifying and building portfolios, and then measuring the sort of how we think about the returns across those different dimensions.
Elaine, so in the systematic active strategy, when you look at the alpha of the factor contributions, and you said you might have a portfolio of 200 or so stocks, right? Is the alpha coming from a little bit from every stock, or is it heavily skewed where you would be like, it's really only 5% of the 200 we have, almost like a venture kind of type thing, excels in that portfolio, and that's what delivers the alpha? What is the actual kind of distribution on average in the portfolio from?
I think a really insightful question. I'm glad you brought that up. I would say it's across many stocks. So typically, if you look at our attribution, which is, you're attributing back the return to each of those positions, I would say let's say we're able to deliver 50 basis points in active return in a quarter. That is typically across maybe 100, maybe 50 stocks in terms of delivering that return. I would say the highest would typically be in the maybe 10, 15 basis points range. And you're going to have some that are able to add value, and you're going to have some that are going to be detracting, right? But on balance, it adds up. But that's with a systematic approach. What you're, I think, keying in on there is the idea of breadth, which is you want many different positions, many different ways to apply. Again, a systematic approach is applying your skill to all of 500 of those stocks. And on balance, it's going to work, hopefully, more than it doesn't. And so, but how that looks in terms of returns is going to be pretty smoothed out over many positions.
Yeah. Thank you.
Mm-hmm. Okay, I will move to the next slide. So here we have just another way to think about from framing the returns, and this is just going down to more of the attribution, exactly what we just talked about. So you can think about the returns coming from, of course, that this is just taking another perspective of what we've been talking about, which is cap weighted or kind of market return versus active return. And then within active return, how much we can dig into, like, what is the return that is from exposure to those factors, and what is the return that is from exposure to the more idiosyncratic or pure alpha. The way that we think about our kind of pure alpha and alpha return is that we are looking to take advantage of what we call informational advantages. I've mentioned a little bit, and we won't go into too much detail in our investment process, but we care a lot about data. And so what we're looking to do is to pick up on what data can tell us out there about what companies we think are positioned likely to do a little bit better, and what companies we think on balance, given these different measures that we have, are likely to do a little bit worse. So it's an informational advantage, and we don't expect that that's going to be there forever. We expect, and we want that should eventually come out through prices, and those prices adjust, and we're able to then take advantage of those positions in the portfolio.
Elaine, another question then. So then from an informational advantage, is it that you have data that other people don't have, or is it really your interpretation of the data that everyone has?
I'd say it's a little bit of both. We tend to be very, I mean, of course, nothing non-public material information, you know, we don't want any MNPI, like that's, you know, the starting point. But we have found and still are very focused on casting a wide net in terms of different kinds of data. We do a lot of things like text processing, especially in the era of machine learning and AI and large language models. You can do a lot with processing different kinds of text. That could be a broker sentiment report. That can be a conference call transcript. That could be lots of different things. But sort of processing that data, and also it's kind of hard to do. It's if I could go to ChatGPT and say what stocks are going to go up tomorrow, that'd be great, but that's not going to work, right? So using the tools, we think that sort of understanding the different tools and techniques available, applying those to the data that's available out there, and we buy a lot of data as well. So this data isn't sort of nicely curated and ready for anybody to use. We have hundreds of different data vendors that we use. So I think there's still value in and work to be done to bring that together and try to make sense of that and use different kind of tools and techniques to process that and turn that into alpha.
Yeah, because I mean, when you say informational advantage, I'm just trying to figure out like, what is that really, right? Is it just access to more stuff, or is it that kind of idiosyncratic internal alpha? But we have people that when we look at the same pool of data, we can prognosticate that the Bills are going to win this weekend versus the Dolphins, right? So,
right. I think it's another example on the systematic side is we capture and process Instagram posts. So, for example, you can, and that's available for, I don't know about anyone, depending on who you follow and, which influencers you're interested in. But that's pretty publicly available information. That doesn't tell you what to trade. And so my take, there's quite a bit of sort of messiness and work to be done to try to process that kind of information and turn that into, what does that mean I should buy or sell? Sensibility is pretty straightforward. But doing that, I think that the edge to me is doing that at scale and doing that across thousands of securities is where the value is.
thank you.
So I'm curious, what's the shelf life for your algo? Like, if you find a few factors that you think are driving price and the price then rises, my understanding is that other people will find those factors rather quickly too. Like it's only a few months or even a few weeks before someone figures out that this factor or these factors have driven the price, and then your algorithm is outdated because you're essentially buying something that's already, the price has been baked in.
Right, and that's something, we're very focused on. So we tend to believe on lots of different data sources. So there isn't sort of like I found the one and that means I'm going to be able to deliver in the next month or quarter or what have you. It's more of a I would call it a mosaic approach. So we have on the order of 1,000 what we call signals. So and I mentioned the hundreds of different data vendors. So it's about piecing those little things together as opposed to one. But you're right, and there could be any one. Maybe there's a data vendor that has their business model is to grow their business, and there's one data piece of information that we have. And that becomes less effective. And that's something that, of course, we're monitoring and we're understanding and making adjustments. But it being that, again, we're kind of focused on the breadth of these things and being able to have many different data sets. And the other thing is, if you think globally, so one thing is in the US, but globally, there's different data sets you can get in China, and there's different data sets in India or those different areas. So I think of our approach as kind of piecing together those little things. And one thing absolutely can happen. I think if I just talk about competition a little bit, I think if I think about other systematic investors, there's quite a bit of focus on systematic investing in the short horizon. So in the sort of what's happening in the next, and it can be even the next minutes, or it can be in the next couple of days. We find our sweet spot being more in the sort of couple of quarters timeframe. So we're not really focused on, that's a tough game to play. Then it really matters where's your server located versus, the execution, that kind of thing.
Yeah.
And that's not where we're playing.
Gotcha.
But it's, absolutely something that we have to try to understand and think about.
Very cool. Thank you.
Also have a question, Elaine.
Sure.
Thank you for the educational session. Enjoy a lot. I often, observe the stock price, change really volatilely, like based on people's reaction. Maybe it's because the market's efficient, participation is really widespread. So rather than focus on like the intrinsic value change, like based on a product strategy and the competitive edge of the company, what the value would generate, but people would often overreact to an event, that kind of information, right? So that affects the price a lot. And is that something that would be in the analysis and monitor?
Absolutely. So the way that we think about that from a systematic perspective, we think about categories of insights of different data that we look at. And one category is fundamentals. Obviously, we all care about fundamentals. We care about how companies deliver on how, are they growing their revenues? Are there new product lines? Those sorts of things. And then the other key category is exactly what you're mentioning, which is sentiment. And so that can be, typically a little shorter horizon. Again, we're not super short horizon, but I would call it, over the next kind of, few months or a couple of quarters. But yes, there can be an overreaction to different kinds of, some news comes out, something happens, and that we will look to try to take advantage on those dimensions as well if we can.
I do that too. Thanks.
And then one last question, building on Trustee Gatto's question. This is essentially like a mega weighted decision matrix, right? Like what you guys are doing, and then you're applying them to different stocks. And so the question that I have is, as to Trustee Gatto's point, it's not one algorithm, but there is a framework. And I'm assuming you guys are going to rebalance it quite often. And so what's the high level process that you use in terms of within the team as you say, okay, maybe it's time to up this factor or down that factor, or there's a new data set here. How much should we use that to cram down some other things? What's the fact? How do you guys think about making sure that you're up to date so that those 3 quarters out, 4 quarters out, you're making good decisions?
Sure. So yeah, I would say a couple of things. One is in terms of how we manage what we would call the model. So ultimately, well, what all investors are doing and what we're doing very specifically and precisely is forecasting returns. That's what we're trying to do. So we have a return forecast, and that gets updated every day. So based on that, now not every data source is going to change every day, but we know what happened yesterday in terms of the price. We know, in terms of maybe there was heavy volume happening in a particular name. Maybe there was new news that happened based on something. So that's one dimension. And then we will look at the portfolios. Again, I would say we're not super high turnover, but probably 100%. So maybe that would be a holding period somewhere, somewhere right around a year, something like that. So we update based on the latest information we have, and then we position the portfolio accordingly. What that tends to mean is, sort of, I contrast it with, a traditional, more fundamental approach, which would be, sort of a buy and hold over years probably, and would trade in terms of block trading. So you would say, okay, these are my buys. We're gonna trade that over, I don't know, a couple of weeks and then hold for a year. Our approach, we would tend to sort of fine tune, typically maybe twice a week, adjust those positions, and it tends to be pretty marginal. You're buying into the companies you like and sort of selling out of the ones that you don't. The other question you asked about weighting, given that we have that sort of hundreds and not close to 1,000 of those signals, that's very hard for, a person to do. I can't make those trade-offs in my head. We use a machine learning pipeline to help us think about and help kind of combine. And you're basically optimizing for the best forecast that you can get.
As a follow-up, the team would then also tell the machine learning how to interpret the different weightings, right? Or is it that the machine learning itself just looks at previous returns or in risk and return? Or is it more, I worked at a hedge fund of funds when I was in B school. The idea of, is the team coming in and like changing those weightings on their own?
Yes. So you're identifying exactly our approach, which is, we like to say, kind of sort of human in the loop. So like the machine doesn't, the machine learning stack didn't build itself, right? These are sort of tools and techniques and things that we're applying. But then we are also with an understanding of what doesn't make it through, like what are the shortcomings of that approach. And obviously there's some sensibility, maybe there's sort of environmental things that are changing that your data that you're training on doesn't include. So that we balance that with there's a human in the loop, that the sort of lead portfolio manager that is looking to make adjustments to those models, and then use that to build the portfolio. All right, this worked out quite nicely timing wise. So this is the last page, and we've kind of done it. Thank you. So yeah, just ending with a bit of the systematic process. So of course, as we've talked a lot about data, that's very important. The sort of second element is what we call scientific testing. What that means is empirical research. So that means if I have a new data set, I'm going to first go and try to understand, was that predictive? Well, first of all, we talk about SPCA, which is any new data set, any idea that we have. We believe very much in sensibility. So that is kind of the first thing. I mean, if we want to look for correlation of data, you can find that anywhere, but that doesn't necessarily mean that that's going to be predictive. So that's something that we're very focused on. Does it make sense that, Instagram posts and likes that are connected to a certain brand or company, does it make sense that that might be an early indication of success or difficulty that a particular company is going to have? Yeah, that seems like that's a sensible idea. So that's the starting point. Then of course the testing from an empirical perspective, has this worked in the past? We also want to make sure that that is consistent. We care about we didn't really go into this, but we care about maximizing what we call information ratio, and that is risk-adjusted returns. So of course we care about delivering returns, but we care about how we do that. We really value consistency and want to minimize the risk or the volatility of those returns that we're delivering. That comes out of a disciplined construction. So we've talked a little bit about that. We tend to have portfolios with hundreds of positions, and sort of think about updating our insights and also our portfolios on a regular basis, typically daily or biweekly. And then I think the really kind of core element here is that, we're never done. This is a continuously refining system. We care very much about innovation. The world changes. It's changed a lot in the 25 years that I've been in investment management, and will continue to change. So we want to continue to evolve, and if there's new data, that's great. There's new techniques. There's new ways to capture, incorporate, and think about investing in a better and smarter way.
Jim, I just want to say thank you, Elaine, for that. I mean, obviously the connection to this is, the lion's share of our overall returns anticipated in the future for our members comes from our collection of growth assets to there. So thanks for allowing us to be a little nerdy and trying to put you on the spot going through that. But yeah, David, if you want to.
A quick question from the different strategies, which one has which one has or has the potential to have the highest return, and which strategy, and I know you're constantly refining, but if you could be in a vacuum, and which strategy over the long run has the higher returns?
So do you mean sort of fundamental versus systematic?
Yes. And yeah, so I know you say you're constantly evaluating and changing, but if you,
I mean, you're talking to a systematic investor, so I think that the way I would think about measuring that would be in terms of risk adjusting the return. So a fundamental approach typically means a very concentrated portfolio. Concentrated portfolios means you're going to have a lot of volatility in those returns. So maybe you're going to have a really good year or a really good couple years, but then you might have a couple years that aren't as strong.
Right.
So I think that you have to, how much do you care about that piece, the sort of consistency, versus the absolute return? And that's the measurement of an information ratio puts that on equal footing, right? So I would say a systematic process tends to be a little bit more consistent, that can compound over time, because the thing with a more concentrated or fundamental portfolio is, can you remain committed to that when it looks really dire, right? When you've had a difficult year, a couple years. And I think so I think it matters the sort of path to that endpoint.
Thank you.
Sure. Great. Any other questions? Thank you very much for coming in. This is very helpful and a great conversation.
Thank you. Appreciate all the questions, and thanks for inviting me.
And as it relates to the start of the BOI meeting, we'll have a 10-minute segment through there for coffee, donuts, and the like. So we'll start at 9:10. Thank you.
Recording stopped.